Hello, everybody, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. My name is Jesse Day, and before we dive in, standard disclaimer, nothing here is investing advice. Do your own due diligence. And today's guest is the author of Bubble 3.0, the co-chief investment officer of Evergreen Gavical, and the author of, in my opinion, the best investment newsletter out there, Haymaker. It's David Hay. How you doing? And welcome to the show.
Wow, Jesse, that's quite an introduction. Thank you for having me back, and thank you very much for what you just said. Those are very kind words. And it's the day heyday. We're gonna have a heyday today.
Yes, let's do it. And I want to start, like I do with all new guests here on Commodity Culture, with the origin story. So, what is the David Hay origin story? How did you first discover investing, and how did that road lead you to where you are today?
Yeah, it's a great question. One of the jokes I tell that's not completely false. It's a little bit enhanced, but that I was buying drug stocks back in high school when my friends were buying drugs. But really, what got me interested in buying stocks was the event that happened in Seattle in the early 1970s, which was really traumatic, which is when Boeing lost the SST contract. It was going to be like the Concorde, supersonic transport. And the company almost went down, and they had mass layoffs. So there was a famous billboard on the outskirts of Seattle saying, "Would the last person leaving Seattle please turn off the lights?" And it was that bleak. And so my first stock purchase actually was Boeing at that point, which I think a few years later, when my wife and I were married, a number of years later, I sold to buy our first furniture. It was, that furniture set probably cost me $100,000, something like that, because I also sold some Nordstroms too. But anyway, it was I was involved in stocks as early as high school, but then in college I went a very different direction than most people in my position, because I am co-chief investment officer of Evergreen Gavcal. They wouldn't say what I'm going to say right now, which is my degree was in cinema studies and filmmaking. So when I went to college, I just fell in love with the cinema. I actually had a mentor, Frank Capra, very famous American film director. He made most people don't even know who he is anymore, even though he won multiple Academy Awards, but he made the Christmas movie, It's a Wonderful Life, with Jimmy Stewart, that everybody remembers so fondly. Anyway, so I went that direction, then realized pretty quickly after college that being in the film industry and eating weren't compatible. So I figured I better get a real job, and I'd always loved the stock market. So I did my best to get hired, and finally some poor branch manager at Dean Witter at Bellevue, Washington felt sorry for me and gave me a shot, even though I was way too young and I'd never sold insurance or other intangibles like they like. But anyway, I had a passion for the business, and I think that's why he hired me. And it was an interesting time because late 70s, we were in the period of the tail end of the terrible inflation that really busted out in the mid 60s. And Volcker would soon, drive interest rates to 20%. And at that point, I became a convert to the belief that he meant business, that he was going to get inflation down. So I really became a bond bull in like 1981, and basically stayed a bond bull with a few exceptions when, we'd be late in an economic cycle and, rates were headed up, inflation was headed up, and we'd shorten duration. But I basically stayed a bond bull until the late summer of 2020, when the 10-year Treasury went down to 0.5% in yield. And I thought that was crazy, especially given the massive amount of stimulus. We were basically doing at that point full-blown modern monetary theory, MMT. So we had massive fiscal stimulus, we had massive monetary stimulus, and I was convinced it was going to cause a lot of inflation, which it did. So anyway, that's a little bit of a background that, playing interest rates was really how I built my business. And it's, now for the first time in quite a while, we've got interest rates again. And we thought they were gone forever. But, and I think that's a really big topic for us to talk about today, because there's definitely some pyrotechnics going on in the bond market right now.
Yeah, absolutely. And let's talk about the broader market and the economy right now. I'd like to dive into commodities as well with you a little bit later. But as you've outlined in your newsletter, there are many signs that a recession seems inevitable. But on the other hand, Team Soft Landing does have some data points that they can look to indicate we could be in a bull market. So where do you stand on the matter? What are you seeing?
Well, I don't think that really matters. My opinion is just an opinion, though I will say that I did call the last three recessions. So definitely have a little bit of credibility there. I think my interest rate calls have been the best. But I think the difference is that those that feel like they have been vindicated because they've been in the soft landing or even no landing camp, which is where Jim Cramer is now, and that should cause anybody that agrees with that to really do a rethink. But the I think the difference is whether you're looking at lagging or coincident data, which definitely looks pretty good, or leading, which looks radically different. So do you really want to drive, looking in the rear view mirror, or even, the side view mirror, as opposed to looking out the windshield? I think the windshield's probably more important. And I think what matters, again, not my opinion, but just look at things that have had a perfect track record, not just a good track record, a perfect track record at calling recessions. The yield curve. And I know a lot of people blow off the yield curve. And I think at times in the past when you could say, well, the central banks were so influencing, the longer rates, buying longer bonds, and, when QE was going on. But that's not the case. Now it's actually QT, quantitative tightening. They're selling. And that's one reason why I'm really worried that we could see interest rates get out of hand on the upside, even in a tough economy, which actually could make the economy even tougher. So that's really part of what I want to talk about. But so the yield curve, and then you've got these things that are called the leading economic indicators. Why do they call them that? Because they lead, and they're down for 15 straight months. You've never not had a recession when you've had a deeply inverted yield curve to begin with, and then you throw the LEIs in there, and it just, makes, I don't know, you can't get higher than 100%. But then if you want to look at GDI, which the more I study GDI, which is gross domestic income, versus GDP, which is what everybody talks about, I'm convinced GDI is more accurate. And if you don't want to believe me, I know you're a Canadian, and you probably are proud of David Rosenberg, one of the more famous economists in the world, and he does hail from Toronto, and he's big on this, and he maintains that, as does Lacey Hunt, by the way, that the GDI is more accurate. Dr. Lacey Hunt, who's a very famous guy, economist in the United States and a bond manager. And so it measures income versus GDP, which is, basically output. And it's interesting, if you look at last year, people forget we had 2 negative quarters in a row of GDP, and GDI wasn't negative. So GDI was right. But if you want another, sobering statistic for those that believe we're likely to have a soft landing, there's never been a time since World War II when GDP was up and GDI was down, which is the case right now, that we haven't had a recession. 100%. So those are just a lot of 100%ers out there that I think are kind of silly to ignore. And actually the gap right now between GDI and GDP is one of the largest seen. So I think the latest data point was that GDI is running at a negative rate of 1.8%. GDP is a little bit over 2. That's a big, big gap. And when the revisions occur, they occur GDP toward GDI. So I think that's a really important factor of it. It's not the other way around. And that's one of the points David Rosenberg has made, is GDP gets heavily revised. Same thing with employment statistics. The numbers that they report at the time invariably get revised. So I just think you want to be looking at the correct data set. And I would opt for the ones that have worked time and time again. And then you just think about the amount of tightening that's going on. This has been a tremendous interest rate increase that we've seen. And we've also got quantitative tightening. The other thing that I think is a little bit of a unique viewpoint is everybody should know that we're having double tightening, the higher rates and the shrinking of the Fed's balance sheet. What they don't really think about is what Lacey Hunt has really studied extensively, and others have as well, and that's the negative multiplier from fiscal stimulus. So this is a very 180 type of view versus the consensus. Most people think, if the government's spending a lot of money, that's good for the market, it's good for the economy. Near term, that's true, but the longer term impact, and the longer term is, like over a year and a half's time. So after about a year and a half of heavy government stimulus, you actually get a drag because of misallocation of capital and moving money from the more productive private sector to the public sector. And Jesse, another point I'd make on that, and I just don't hear people talk about that, is, so nominal GDP is running about 5% right now in the U.S. So that's growth plus inflation, maybe a little bit higher than that, but right around that. But the deficit spending is 7 to 8% of GDP. How healthy is that? So if you took away that government spending, which in the long run is actually contractionary, but in the short term gives kind of a steroid type of boost, the growth is negative. So I just try to look at the data. I mean, I'd like to see a soft landing. That's probably the best scenario for a lot of our holdings, but I don't think that's the likely outcome, unfortunately.
Yeah, the vast majority I speak to echo a lot of those sentiments. You spoke about the bond market, and I wanted to get your thoughts on Fitch downgrading the US credit rating to AA plus, which when we were offline you said was still too high for the United States. So what are the implications of this? Why did this downgrading happen, and how will it impact the bond market up ahead?
Well, I don't think it means that much. I mean, it's if you look at the last time the U.S. was downgraded, it just was a passing thing, and we were off to the races. But it was a very different time from a budgetary standpoint. That's really when we had the Tea Party movement in the United States, and you really did move to a somewhat restrictive fiscal stance. At least the debt to GDP rate was going down a bit as opposed to exploding like it is right now. So I think the really big news that happened at almost the same time as that downgrade was the Treasury's announcement that they're drastically upsizing the amount of money they have to raise in the second half of the year to 1.85 trillion. 1.85 trillion in 6 months. So that's basically saying we're running a deficit of that amount of money, and we need to raise bonds, go to the bond market to come up with that. And the problem they've got is at the same time as the Fed, instead of buying, which they did for so many years, ever since the global financial crisis, the Fed is now in a selling mode, and they're selling it, close to $1 trillion, right around $1 trillion a year annual clip. And then you got the banks that are just absolutely loaded to the gunnels with treasuries. I mean, that's why if you really mark them to market, there's probably very few solvent banks in the U.S. We already had three of the largest bank failures in U.S. history. Everybody assumes that's kind of calmed down, but if you look at and I sent you this chart, in which hopefully you can integrate into this podcast of the 10-year Treasury yield, is clearly busting out to the upside. So this is breaking above 10-year resistance and kind of sprinting. That's what often happens is when these breakouts occur, then the move there's really no resistance. It just keeps going. And is it going to stop at 4.5%? I think it's about almost 4.2 today. Maybe, but could it go to 5? Yeah, pretty easily it could go to 5, especially with a tsunami of supply coming. So I just think people are not looking at that. They don't realize, or they don't pay enough attention to the fact that the U.S. really could have a funding crisis. That's not bullish, as far as I know.
Well, let's kick off the commodities conversation now and talk about the oil and gas sector. You've described energy as the most cherished of your favorite boats in a recent newsletter. Strong words. So, why do you feel that way? And have all of the big gains been made since the oil price briefly went negative in 2020? A lot of people who got in at that time have had fabulous gains. So a lot of people are looking at the sector and thinking, okay, well, the big money's already being made. There's no point in investing there. Do you think there's more upside up ahead, or is the party over?
Definitely the party's not over. I do think the easy money's been made. We put out a newsletter back in December of 20 when they were still, you mentioned April, that's when oil went negative in the futures market. And yes, that was kind of the bottom, but they were still super cheap in December 2020. So my newsletter at that time was called the Evergreen Virtual Advisor. And the title of that one was Totally Toxic, because I made a comparison with the attitude of investors towards energy at that time versus tobacco and Philip Morris back in 2000. And the point I made was that if you bought Philip Morris stock in 2000, you would have crushed the S&P over the next 20 years. Not even close. And my other point, which is kind of related, I know one of your personal beliefs, is that unlike tobacco, energy is absolutely essential for human life and flourishing in a modern world. So anyway, fast forward to today, and last year and the year before, tremendous returns out of energy. But then this year it corrected hard. And so that's why I put out on June 23rd usually when I endorse something, I say, but buy lightly, go carefully, because we're still in a bear market, which I believe. I know that's pretty controversial right now. But on June 23rd, I basically put out a table pounder saying energy is just really attractive right now. You had stocks like Apache, APA that had fallen from 50 to 30, 40% decline. I mean, serious bear market. And we're trading at, single digit PE and huge free cash flow yield, double digit free cash flow yield. And so now since June 23rd, and this is why I was happy that this broadening rally that we've had since June 1st, because if your listeners don't know, in the United States, the first 5 months of the year, it was just a handful of companies, the Magnificent Seven, which we all know who those are, that provided all the return. But I did expect, I think it was June 12th, I said we could be seeing a broadening out of that rally. And that's definitely what happened. And yet it kind of left energy at the station until we got really lucky with our timing. And energy's had a great move over as oil prices. Oil prices are up, I think, more than 15% now from where they were in late June. The question is it too late now after that move? I'd say it's certainly not a table pounder anymore. I think, it's worth, if you don't have any energy exposure, that's probably a mistake. I think it's actually definitely a mistake. And a lot of people are in that boat because they just have this aversion to fossil fuels, which I think is misplaced, but that's kind of a personal choice. If you don't have that bias, I'd say, look for weakness. It's a volatile area, and I think it will continue to be volatile. But there's a guy named Scott Sheffield, if you don't know who he is, CEO of Pioneer, one of the very best of the Permian oil and gas producers. He thinks oil is going to 100 by the end of the year. I think he's right. So I would, if anybody's followed our advice, which I don't think any of your listeners probably get our newsletter, so they probably didn't. But anybody that did, I would be maybe trimming a little bit here, but I would still keep a core position. Energy is very small. It has very small weighting in the S&P. And so it's still got a lot of catching up to do. Okay, kind of a long-winded answer. Sorry.
No, I love it because my portfolio is probably too heavily weighted with energy, so it's something I like to get different people's opinions on. And again,
You better take some profits then, Jesse.
Yes, well, actually, I'm very conservative with my investing. Most of it's in XLE, so I'm just kind of riding that out for the long term. I'm not very. I know that I don't know enough to be going around speculating on too many individual stocks in that space. But a space that I'm very fascinated with, and I completely agree, people underestimate how important energy is, how important oil and gas is. There's this whole obsession with the new green economy, and we're going to switch everything to, EVs and solar and wind, etc. But first of all, that's not going so hot, and secondly, the amount of fossil fuels and oil needed to mine those minerals to then create those things is absolutely massive. So as somebody I like to listen to, John Polemy says, heads we win, tails we win more when it comes to the energy space. Whatever happens, it looks bullish up ahead, in my view, for the long term. I'm not a short-term trader. I look at more the long-term time horizon. But speaking of energy, you've been consistently listing uranium as one of your champions in the ring edition of your newsletter, where you talk about various asset classes that you're bullish on. So what are you seeing that makes you so consistently bullish on uranium?
Please allow me to come back to that, but I do want to finish on another major development that happened in the oil area this week, and that was the DOE's announcement that U.S. oil inventories fell at the fastest rate in 40 years. And that, inventories have been a big source of controversy. It gets back to our earlier discussion about misleading government statistics, because what the market tends to focus on is the gross inventories, which include the SPR, Strategic Petroleum Reserve releases, that were unprecedented. And the SPR is now drawn down to the lowest level it's ever been. And so that has really been obscuring how tight the market is. But you're now starting to see, and that's one of my bullish planks for the rest of the year, is that I think people are going to continue to be shocked by how much inventories draw, and they're already dangerously low, adjusting for the SPRs. So that's that's one reason why I would say that buy any pullback in energy, because it's what really drives the group is higher prices. And what drives prices? It's the supply demand dynamics, which I think are just extremely positive, other than that kind of that illusion created by the SPR releases. Okay, as far as uranium goes, it's I think in fairness with the oil and gas, at least in the developed world, the growth in demand is going to be quite sluggish, maybe even negative. Where you're going to really see a lot of demand growth, and this has been the case for the last 15 years, is from the developing world, the emerging countries, where the growth in demand for oil and gas is very strong, and I think that will continue. But in uranium, the demand is just becoming unbelievable. I mean, this was an industry that was in terminal decline, particularly after Fukushima, when reactors were being closed around the world, shut down, and now they've got 60 light water reactors. So these are the big, 1,000 megawatt types of reactors that are under construction around the world. A third of them are in China. So that's bullish enough. Supplies have been drawn down. Inventories have been drawn down for years. That whole megatons to megawatts where they were converting nuclear missiles, decommissioning, and then using the uranium for power production, that's been exhausted. You've got definitely supply risks coming out of Russia and Kazakhstan, which is the biggest uranium producer. So you've got supply problems and you've got demand, which is going vertical. And to top it all off, my favorite area is small modular reactors, which have been for years just this almost like fusion. Now, these are fission, not fusion, but they've been as much of a dream, impossible dream as fusion is. And I do think fusion is still way, way down the road. But these small modular reactors are getting closer to actual production. I'm involved with one, and full disclosure, I'm an investor. I'm a big cheerleader of micronuclear, and they've got a small modular reactor, which is actually based on molten salt reactor technology, which I think is, from all the research I've done, which is quite a bit, I think it's the best. But regardless, look at what Bill Gates has done. Look at Sam Altman now from ChatGPT. He's now invested in a company called Akla that he's rolled into a SPAC with an $850 million valuation. There's also NewScale out of Corvallis, which has gone public. There's a couple of others that are getting pretty far down the road. I think you're going to actually, the folks I'm talking about that are based in Idaho, I mean, they're ready to cut metal and get to fission right away. But the problem has really been regulatory. The NRC, the Nuclear Regulatory Commission, I semi-facetiously say it should have an A in front of it for anti-nuclear. They have just consistently, there's only been one nuclear facility approved since the NRC was established. And I believe that was Vogtle. I know the two Vogtle plants in Georgia are just coming online. They were originally going to cost $14 billion. They're going to cost closer to $30 billion. So that's the problem with these light water reactors in developed countries, and particularly the United States, is they just are so fantastically expensive to build because the regulatory environment is extremely hostile. I mean, they have to have all these redundancies to protect against any kind of an accident, and it makes it really cost prohibitive. And of course, they're bureaucrats, and they have all downside and no upside to approve something that turns out to have a problem. So they're very reluctant to put their stamp of approval on anything. And that's why I think with these small modular reactors, you can get around that by having them located at military bases and other venues where you don't have to have NRC approvals. I won't go into all the details, but I do think these guys realize they have to do an end run around the NRC to get it to happen. I think once it starts getting out there and people realize these things are walk-away safe, they don't have the problems that those big light water reactors do, safety risks. They can also recycle the fuel. So I think there's a very positive story, unbelievably positive story, really, for the nuclear industry. A true renaissance, a word that's probably overused, but uranium is still trading at well below what it would cost to actually build a new uranium mine. It's trading kind of mid 50s. It's kind of been there for a long time, and a little bit lower, a little bit higher, and there is an ETF that investors can use that's operated by one of the best resource-based companies, money management companies out there. And it's trading at a bit of a discount from net asset value. It's popped up a little bit here lately. I did re-recommend it when it dipped a few weeks ago, but it has recovered a bit. But it's still attractive. I mean, that's one where you probably don't trade that. I think that's going to have a monster move at some point. So that's my story in uranium.
Yes, you're preaching to the choir there. We love uranium on this show, and the only thing I'm more overweight in my portfolio than oil and gas is uranium. So I'll always appreciate hearing your outlook on that in your newsletter as well. I've learned a ton from reading that. I do want to switch over to copper producing stocks now. This is another asset class you're bullish on. Talk to us about that, and also, where do you look for opportunity in the copper space? Is it more the major producers like Freeport McMoRan? Do you speculate on explorers, developers? Do you go with the ETF like COPX? How do you approach the sector?
Well, primarily we've used the blue chip copper, U.S. blue chip copper name, which you can easily identify. I have to be a little careful. We do have another secondary producer that is a bit more speculative, but is also cheaper, probably has more upside. But, right now they've rallied a bit, so I wouldn't run right out and be a big buyer, but I do think the long-term story is very positive. And a lot of it has to do with EVs, which personally I think there's going to come a moment when at least the car industry, auto industry starts to have second thoughts about kind of this all-in attitude they've had toward EVs. I think you're starting to see some of that already with some of these companies really struggling, Ford in particular here recently, but they won't be alone. I'm just not sure there is the consumer demand for them that is popularly believed, or at least politically believed, but they're going to keep pushing and they're going to keep giving all kinds of incentives. So it's like 3 to 5 times more copper usage in a EV than there is in a traditional internal combustion engine. So and also I do think this reindustrialization of America is for real. So there'll be a lot of copper demand for that as well. Uh, I think copper could easily double in price over the next 5 years, which would be very good for the miners. But as I said, they seem to be a little ahead of themselves right now.
So I wanted to get your view on gold and gold producing mining stocks here, because that's another asset category that you've included in your champion section. Where do you see them both positioned? Are you a bit of a gold bug in that you look at physical gold as a way to remove your wealth from the clutches of the traditional financial system and from government overreach, and obviously a hedge against inflation, all of those things, more of a savings instrument and an insurance policy against government malfeasance, hyperinflation, etc.? Or do you look at it as an actual investment, the physical metal that you hope will go up, or is that something you more look to the actual mining stocks themselves for?
I would say it's both. I think that when you're talking about the insurance policy and you're trying to, protect your wealth against these terrible fiscal policies that we've got right now in the West, but, I'd say particularly in the United States, having physical gold, and you don't have to, it probably makes sense for everybody to have some physical gold. That, the storage part of it's a little tricky, but probably can handle that. For our clients, there's a closed-end fund that's 60% gold, 40% silver. It's actually Canadian. The gold is held at the Canadian National Mint. You can actually take delivery of it if you want. There's a minimum size, but it's not that high. And so that to me is like the perfect insurance policy, and it's very convenient. But to make a lot of money in a gold bull market, you got to look at the miners. And actually, I'm going to be writing those up tomorrow. So I'm actually touting the junior gold miners because they have been absolutely crushed over the last 11, 12 years, even over the last couple of years. This particular ETF got up to 60 back in 2020 when they were running. It's now at about 36. And just the reality is whenever gold moves, you make more money with gold miners. But having said that, I think when you compare the profitability of even the senior miners, the best of them, like Newmont and Barrick and even Agnico Eagle, which is probably the best run of all the majors. But you look at their profits today versus where they were in 2011, 2012, when gold was lower than it is today. It was around 1,800 at the peak, and now we're knocking on the door of 2,000, and their profits are way down. So you would think if they were well run, that profits would be up. And if you look at companies like Exxon and Chevron and most of the leading energy producers, oil and gas producers, their profits are significantly higher than where they were, 11 or 12 years ago. When oil actually got to $140 even 15 years ago, but it was in the kind of the 100, 120 range, back in the early part of the last decade. And it's down from that, down a lot. And gas is down a lot, natural gas. And yet their profits are way higher than they were. So you got to say that the mining industry, gold mining industry, has not done a good job for investors. I do think they're kind of getting the same religion that the oil and gas companies have had, which is another reason why I think we're going to have a chronic shortage going forward of oil and gas, is because they are being so careful about reinvesting. And, the problem with, this is getting back to oil and gas, but with particularly shale oil more than shale gas. And if your people don't know this, it's just a fact, is that virtually all the growth in oil production that's happened in the world over the last 15 years has been from U.S. shale. And most of that has come from the Permian. Like 75% of that has come from the Permian Basin, like 5 or 6 counties in Texas. The people at Gary and Rosenzweig do a great job on this, that if you look at between U.S. oil and U.S. natural gas, it's like we found 2.5 Saudi Arabias. That's how unbelievably prolific shale has been. Now, the downside with that, particularly with oil, is the decline rates are very high. And yet the drilling rig count is down. And I've heard some people blow this off. Oh, well, it doesn't really matter. They're so productive. Oh, actually, the productivity is falling in all the basins, even the Permian now. That should be a tremendous red alert, but people aren't focusing on that. Even some so-called experts who I just listened to the other day that I wanted to, well, I disagreed rather firmly with his viewpoints. So we have the supply situation is already challenged. It's going to get more challenged. And that's why, if I had to pick between oil companies, oil and gas companies, and gold, I would go with oil and gas. But gold companies have been hit hard lately. And I do think there is this potential for a real quantum leap in the price of gold, where you could see it at 5,000, even 10,000 an ounce at some point because of a crisis of confidence in the fiscal capabilities of the Western economies. And one of the things I believe is that there's such a broad conviction right now that we are going to have this Goldilocks type of environment with no recession. I've already talked about that, but also that inflation is going to stay down. I have real doubts. I think what we're more likely in is a going is in stagflation kind of environment. When you look at these price increases, Pepsi is raising prices 15%. They just did that. And a whole bunch of consumer companies are raising prices at 6, 7%. Heineken. Look at the insurance premiums and how those are going up. And part of the reason we had such a good June CPI number was we were comparing against a very hot CPI number in June of 2020. It's going the other way now. A lot of that's driven by energy prices. So the fact that energy prices collapsed there for a while was a big positive for bringing inflation down. And same thing with most commodities, even the agricultural commodities. Now they're starting to go up, and it looks like you got Putin weaponizing grain in the Ukraine. What if he weaponizes energy? What if he takes out a major pipeline that still runs through Ukraine, which I think is entirely possible. So I think this idea that inflation is going to stay quiescent is probably too optimistic. So the market's just all in on this whole Goldilocks thing. And if it turns out to be more stagflationary, I think that's going to trigger a pretty severe correction. We didn't really ask that, but I threw that in there anyway.
So I want to touch on investing in the defense industry because that's something you also discuss in your newsletter. And my question is more philosophical in nature. And that is, I personally can't bring myself to invest in a company making weapons. And the same goes for alcohol, tobacco, toxic food products like Coca-Cola. Maybe I'm taking it too far there. I don't know. But do you feel there is a moral quandary at all in investing in the defense sector? And could you talk us through how you think about that?
Well, first of all, my partner and great friend Louis Gobb, who's a famous guy unlike me, believes the same way. He calls them the merchants of death, and so he won't touch them either. I guess I would look at it very similar to energy. I don't think you can run the world without energy. I don't think you can defend the world without U.S. defense stocks. You can run the world just fine without crypto, without Pepsi, without Philip Morris. Those things are not essential, but I think it's once again naive to not believe that we need to have strong military defense. I mean, personally, I love the Patriot missile because and that's made by Lockheed, of course, but it's a defensive weapon, and it's really it's performing fantastically well, surprising everybody, the Pentagon and even Lockheed Martin, with how well it's doing, even against the Russian hypersonic missiles. So I think in a world where you've got such a militant Russia and a pretty militant China, you got to have that industry. I would not want to rely on, the benevolence of either Xi Jinping or Vladimir Putin and be defenseless against them. So to me, there's just no question. But I understand other people feel differently.
Yeah, that is a good way to put it. And I want to end on a quote from a book that was recently released called The Great Taking. And the quote is, "In the 1930s, all commodities with the sole exception of gold bottomed at the lows of the prior 60 years. Most public companies ceased to exist. They had gone bankrupt. The shareholders were wiped out. The assets were taken by the secured creditors, the banks selected by the Federal Reserve System. Price levels did not recover for decades." So in the case of an outright depression on par with the 1930s, could we see a similar scenario play out with commodities?
Well, I guess my best thing is to reply to your quote with another quote. And this one is from Gary and Rosenzweig, and it said, "A simply Simple, equally weighted portfolio of energy, base metal, precious metal, and agricultural stocks bought at the market peak in 1929 more than doubled by 1938 compared with the broad market that remained 50% lower. So I don't know. I mean, when you look at the chart, like the one I sent you, they had they fell sharply during the crash, but then they rebounded drastically. But I guess I'm sure there were commodity producers that were leveraged that when bad times hit there for a year or two that they got wiped out. But I know homestake mining was an outstanding performer in the 1930s. I know that's gold, but it sounds like it wasn't just homestake. It sounds like there were a number of ag stocks and other commodity stocks that performed very well. I don't think we're going to have 1930s, by the way. I don't think that will be allowed. I think what's a much more likely decade is the 1970s, where inflation was chronic. It would cool down for a while, then it would take off. And personally, I think that's what has to happen to get the U.S. leverage down. I mean, the U.S., being the reserve currency that it still is, can't default. It's interesting. I was thinking about this the other day. You emailed Louis Goff about this. I think these rating agencies need to have a different rating category, and that's inflation-adjusted default or return on your money. So, in other words, if you're going to likely have to resort to high inflation, that when you do an inflation-adjusted credit rating, it's a lot lower than a credit rating just speaking nominally. And in that way, you would say, yeah, the U.S. probably should be AAA, but there's got to be some calculation made for getting repaid in what Ray Dalio calls printing press money. And I think that awareness is now starting to grow. And it's going to be a hard battle for the Fed if you get enough people that say, geez, I don't want to buy those long bonds, even at 4.5% or 5%, because they're going to inflate that away. And so I think what we're leading to, frankly, is a situation where the banks are going to be forced to hold more reserves, which is already on the table. And those reserves will have to be in zero interest bearing form, and basically reserves that they get nothing on, which is just going to create more ability for the government to finance itself at zero interest rates, which is, I think, a highly inflationary situation. And as that awareness spreads, I think that's where you could really see a huge move in the price of gold. So I think commodities are going to be one of the best ways to preserve wealth for people this decade. And as you know, I mean, you've seen that chart, and they're very undervalued compared to the stock market, one of the most undervalued they've ever been. So it's kind of I think it's a freebie for people almost. And yet very few investors have exposure there of any meaningful degree, other than you and me.
You're right. And the people watching this show. Yeah. Right. Well, thank you so much, David, for joining us today and sharing all your knowledge with the audience. Before I let you go, for those who want to learn more, could you tell us about the Haymaker Substack?
Sure. Well, this is a big week for us, too, because we are going paid for the first time. And so that's, I guess, good for us. I am very worried. It is one of the scarier moments of my career. But we will have a lot of free content still. So our Making Hay Monday goes out amazingly on Mondays. And it has a couple of charts of the week with some commentary. And then about the first half of the rest of the main section is also available, will be available for people that don't want to pay. But for those that want to get our actual investment guidance, and we do a lot in the income world because most of our competitors don't. So I think we have a real competitive advantage, and that's been the strength of me, really going back to, like I said, to the Paul Volcker days is, generating income with either bonds or even high income equities. And anyway, so that's what you can access that at Substack, Haymaker at Substack. You can also go to the Evergreen website, where I am co-CIO. They put out some pretty good newsletters as well. And they do have, for those that don't want to manage their own money and particularly feel like they can't do it in the bond world, that's really right up our alley. So thanks for asking that, and thanks for inviting me back.
Yeah, I'll put links to that in the description below. And I think it's about time you went paid. I was just blown away by the amount of free information you were giving out. It's like 2 emails a week and amazing stuff. So I think that makes sense. So congratulations on that. And once again, really appreciate you having on the show, David, and hope to talk again soon.
Thank you, Jesse.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.